I lost a phone call with Jamie Dimon 3 weeks ago that I've been replaying in my head every single day since. We were supposed to talk for 15 minutes about a routine partnership discussion. The call lasted 4 minutes and 37 seconds. I know because I checked afterwards. Jamie cut it short, said he had an emergency, and the tone in his voice, I've known Jamie for 26 years. I've never heard him sound like that. Stressed, yes. Concerned, absolutely. But this was different. This was fear. And when the CEO of America's largest bank sounds afraid, you pay attention. Now I'm going to tell you something that's going to seem unrelated, but stay with me because it connects to everything. Last Tuesday, I was having breakfast at my house in Medina, and I pulled up JP Morgan's first quarter earnings report for 2025. I do this with most major companies, not because I'm looking to invest, but because I'm curious about how businesses are adapting to change. And buried on page 43 of their supplemental materials, there was a single line item that made me stop chewing. Unrealized losses on held-to-maturity securities, $87.3 billion. Now you might be thinking Warren Buffett talks about unrealized losses all the time. It's just paper, it doesn't matter until you sell. And normally you'd be right, but this isn't normal. And JP Morgan isn't your typical bank. Let me back up and tell you why this matters and why I'm frankly terrified about what's coming. You see, most people think banks make money by taking your deposits and lending them out at higher interest rates. That's partially true, but it's not the whole picture. Banks also invest a huge portion of their deposits in securities, mainly U.S. Treasury bonds and mortgage-backed securities. They buy these when interest rates are low, planning to hold them until maturity. The technical term is held-to-maturity portfolio, and it's supposed to be the safe, boring part of banking. Emphasis on supposed to be. Here's where it gets interesting, and by interesting I mean potentially catastrophic. From 2020 to 21, during the pandemic, the Federal Reserve dropped interest rates to basically zero. JP Morgan, like every other bank, took the deposits flooding into the system and invested them in Treasury bonds yielding maybe 1.5%. Made sense at the time. Safe, government-backed, predictable returns. But then something happened that nobody at JP Morgan expected, at least not this fast. The Fed started raising interest rates at the most aggressive pace in 40 years. By mid-2023, rates hit 5.33%. And here's the brutal math that's keeping Jamie Dimon up at night. When interest rates go up, the value of existing bonds goes down. It's inverse. It's mechanical. It's unavoidable. Think about it this way. If you bought a 10-year Treasury bond in 2021 paying 1.5%, and today I can buy a new 10-year Treasury paying 4.5%, your bond is worth significantly less. Who wants your bond paying 1.5 when they can get 4.5? Nobody. So if you had to sell that bond today, you'd take a massive loss. That's what unrealized losses means. JP Morgan is sitting on $87 billion of bonds that are worth way less than what they paid for them. And that number, it's actually grown since last quarter. Now JP Morgan will tell you, and they're technically correct, that these are unrealized losses. They plan to hold these bonds to maturity, so they'll eventually get their full principal back. No loss if you don't sell, right? But here's the thing nobody wants to talk about. The thing that made my stomach drop when I saw Jamie's face on our video call. What happens if JP Morgan needs cash? What happens if depositors start pulling their money out faster than JP Morgan can generate liquidity? Then those unrealized losses become very, very real. You remember Silicon Valley Bank? That was March 2023, $16 billion in assets, gone in 48 hours. The second largest bank failure in U.S. history. Want to know why they failed? Unrealized losses on their bond portfolio. They bought long-duration bonds when rates were low, rates spiked, depositors got nervous and started withdrawing. Silicon Valley Bank had to sell those bonds at massive losses to meet withdrawals. Word got out, and boom, bank run. $16 billion evaporated. Now JP Morgan has $3.7 trillion in assets. They're not Silicon Valley Bank, they're 23 times bigger. But they're facing the exact same structural problem, just on a scale that could break the entire financial system. And here's what really concerns me. Jamie Dimon knows this. He's one of the smartest financial minds on the planet. He survived the 2008 financial crisis. He saw what happened to Lehman Brothers, to Bear Stearns, to Washington Mutual. He knows how fast confidence can evaporate. And that 4-minute phone call told me he's seeing something in the data that scares him. Let me tell you what I think he's seeing, and why I've spent the last 3 weeks quietly stress testing my own company's banking relationships. The commercial real estate time bomb. This is the part where people's eyes glaze over, because commercial real estate sounds boring. It's not. It's potentially catastrophic. JP Morgan has $131 billion in commercial real estate loans. That's loans to office buildings, shopping malls, hotels, apartment complexes. And the commercial real estate market is in free fall. I'll give you some context. Amazon, my company, we announced in February 2023 that we're requiring employees to return to office 3 days a week. You know why? Not because I don't believe in remote work. I actually think remote work can be incredibly effective. We did it because our offices in Seattle and New York and San Francisco, they're sitting at 30 to 40% occupancy. We're paying for space we're not using. And we're one of the most successful companies in the world. Now imagine the struggling companies, the ones that downsized during the pandemic, the ones that went fully remote.
They're not renewing their leases. Office vacancy rates in major cities are at record highs. San Francisco is at 36% vacancy. New York is at 22%. And it's not getting better, it's getting worse. Here's the connection to JP Morgan. Those office buildings, they're financed by loans, huge loans. And those loans are on the balance sheets of banks like JP Morgan. When a building is 30% vacant, the rental income doesn't cover the loan payments. The building owner defaults, the bank forecloses. But here's the problem. When JP Morgan forecloses on an office building in today's market, what's it worth? If everyone's working remote, if nobody needs office space, what's a vacant office building in downtown San Francisco actually worth? Maybe half of what it was worth in 2019, maybe less. JP Morgan's commercial real estate portfolio has a weighted average loan-to-value ratio of 68%. That sounds safe. That means the buildings are worth more than the loans, so even if someone defaults, JP Morgan recovers most of their money by selling the property, except that's based on 2021 valuations. If those properties are actually worth 30 or 40% less today, which I believe many of them are, then JP Morgan is staring at tens of billions in potential losses, and they can't hide behind held-to-maturity accounting for loans. When a loan defaults, you have to recognize the loss immediately. I was in New York 2 months ago, and I took a walk through Midtown Manhattan. I do this whenever I'm in the city because I want to see what's actually happening, not what the data says. I counted the 4 lease signs. I walked past the WeWork locations that are now closed. I looked at the ground floor retail spaces that are empty, and I thought about the leverage in the system. Every one of those empty spaces represents someone who can't pay their rent, which means the building owner can't pay their mortgage, which means a bank is going to take a loss. Scale that across every major city in America, and you start to understand the magnitude of what's coming. Now, commercial real estate alone wouldn't sink JP Morgan. They're too big, too diversified, too well capitalized. But it's not just commercial real estate. It's the combination of pressures that concerns me. The bond portfolio losses, the commercial real estate defaults, and the third factor, the one that nobody's really talking about yet, deposit flight. This is where it gets really dangerous. JP Morgan has $2.4 trillion in deposits. That's money that individuals and businesses have put in checking accounts, savings accounts, money market accounts. And historically, that money just sits there. People don't move their checking account very often. It's called sticky deposits in banking jargon. But something fundamental has changed. For the first time in 15 years, there's an alternative to keeping your money in a bank paying 0.5% interest. You can buy a treasury bill directly from the government yielding 5.2%. Risk-free, no bank needed. I've noticed this in Amazon's own treasury operations. Our treasury team has been gradually shifting more of our cash into direct treasury investments and money market funds instead of bank deposits. It's just basic financial management. Why would we leave billions sitting in a bank account yielding almost nothing when we can get 5% risk-free elsewhere? And we're not alone. Every sophisticated corporate treasurer in America is doing the same calculation. The data backs this up. Bank deposits have declined by $893 billion from their peak in April 2022 through the end of 2024. That's the largest percentage decline since the Great Depression, and it's accelerating. Here's why this matters for JP Morgan specifically. When deposits leave, banks have 2 choices. They can either sell securities to raise cash, which means realizing those unrealized losses we talked about, or they can borrow money, which is expensive and erodes profitability. JP Morgan's net interest margin, that's the spread between what they earn on loans and what they pay on deposits, has been declining for 6 straight quarters. They're getting squeezed. And if deposit flight accelerates, that squeeze becomes a vice. I had a conversation with a friend who runs a hedge fund, someone who's been watching banks closely since 2022. He told me something that stuck with me. He said, Jeff, the thing about bank runs is they don't happen because banks are actually insolvent. They happen because people think banks might be insolvent. It's a confidence game. Once confidence breaks, the reality doesn't matter anymore. And right now, confidence in regional banks is already shaky. But if confidence in JP Morgan breaks, if America's most systemically important bank faces a run, we're not talking about a banking crisis. We're talking about a complete collapse of the financial system. That's hyperbole, right? JP Morgan is too big to fail. The government would step in. The Fed would provide liquidity. FDIC would backstop deposits. All of that is true, and it's exactly what terrifies me. Because the last time we had too big to fail bailouts was 2008, and the political and economic aftermath nearly tore this country apart. We got Dodd-Frank regulations. We got Occupy Wall Street. We got a populist backlash that's still driving our politics 17 years later. If we have to bail out JP Morgan in 2025, in this political environment, with this level of wealth inequality, with this much anger at institutions, I genuinely don't know if our system survives it. Let me paint you a scenario, not a prediction, but a scenario that keeps me up at night. It's August 2025. Commercial real estate defaults have accelerated. JP Morgan announces a larger than expected loan loss provision, maybe $12 billion for the quarter. The stock drops 8% in one day. Some analyst at a ratings agency publishes a report questioning JP Morgan's capital adequacy. It's overblown, it's alarmist, but it goes viral on social media. Within 48 hours, retail depositors start withdrawing cash. Not a flood, just a trickle. 10 billion here, 15 billion there. Corporate treasurers get nervous and start moving money to money market funds. Now it's 50 billion. JP Morgan has plenty of liquidity. They can handle this. But the optics are bad. CNBC runs a story. Is JP Morgan the next Silicon Valley bank? By day 3 it's 100 billion in withdrawals. JP Morgan starts selling securities to raise cash. Those unrealized losses, now they're realized. The stock drops another 15%. Other banks start seeing deposit outflows too. Contagion. By day 5 the Fed announces emergency lending facilities. The FDIC guarantees all deposits at major banks. The Treasury Secretary goes on television to calm markets. And it works. Sort of. The run stops. But JP Morgan stock has lost 40% of its value. Regional banks are down 60%. Credit markets have frozen. The S&P 500 is down 23% from its peak. We're in a recession by any measure. Could this happen? Honestly, I don't know. Jamie Dimon is doing everything he can to prevent it. JP Morgan has 14.8% Tier 1 capital ratio, which is strong. They have multiple lines of defense. They stress test constantly. But I've learned something in building Amazon over the last 30 years. Systems are fragile. Complex systems can collapse faster than anyone expects. And our financial system is the most complex system humans have ever built. You know what's interesting? I've been accused of being paranoid throughout my career. When I started Amazon in 1994, everyone said online retail would never work. Too many obstacles. Shipping costs too high. People want to touch products before buying. Credit card fraud. I ignored them because I was focused on the customer experience, not the obstacles. But I was paranoid about execution. Obsessively paranoid. I still am. Every Amazon executive knows my famous saying, it's always day one. The moment you think you've made it, the moment you get complacent, that's when you're already dying. Banking has gotten complacent. The decade from 2012 to 2022 was so easy for banks. Interest rates were low. The economy was growing. Defaults were minimal. Deposits were flooding in. Banks made money hand over fist with almost no risk. They got comfortable. They got optimistic. They loaded up on long-duration bonds because the yields were slightly higher. They made massive commercial real estate loans because real estate always goes up, right? They assumed the good times would continue. That's not paranoia. That's complacency. And complacency kills. Here's what I'm doing personally, and I'm not giving financial advice, but I think it's important to share how I'm thinking about this. First, I've diversified where Amazon keeps its operating cash. We used to have most of it concentrated in 3 or 4 major banks. Now it's spread across 12 institutions, plus significant holdings in treasury bills directly. I've instructed our treasury team to maintain enough liquid assets that we could operate for 90 days with zero access to credit markets. That sounds extreme, but I remember March 2020, when credit markets briefly froze during the pandemic. Companies that needed to borrow money suddenly couldn't. Having liquidity is freedom. Second, I'm watching the data obsessively. Every Friday I get a report on our banking relationships, deposit balances, credit line availability, counterparty exposure. I look at JP Morgan's weekly earnings reports. I track commercial real estate delinquency rates. I monitor the Fed's balance sheet. Most CEOs delegate this to their CFO. I don't, because if there's a liquidity crisis, I need to know immediately, not after a 2-week delay while information flows up the chain. Third, and this is harder to quantify, I'm preparing mentally for volatility. The next 6 to 18 months are going to be chaotic in financial markets. There will be days when the market drops 3% for no clear reason. There will be headlines about bank stress. There will be emergency Fed meetings. Some of it will be real crisis. Some will be noise. The key is not to panic, but also not to ignore real warning signs. It's a balance. I want to circle back to that phone call with Jamie Dimon, because there's more to the story. Before he hung up, he said something that's been echoing in my head. He said, Jeff, we're managing through it, but the scenario planning is getting darker. I asked him what he meant. He paused and I could hear him choosing his words carefully. He said the models they're running, the internal stress tests, they're showing outcomes that are worse than their regulatory stress tests assume. The Fed makes banks test against severe scenarios, 9% unemployment, 30% drop in real estate prices, that kind of thing. Jamie was saying their internal models are showing potential outcomes beyond those assumptions. I didn't press him for details because I could tell he was already uncomfortable sharing that much. But think about what that means. JP Morgan, the most sophisticated financial institution in America, is modeling scenarios worse than what regulators consider severe. What kind of scenarios? I've thought about this a lot. Maybe it's a combination of multiple shocks hitting at once. Commercial real estate crash, plus a recession, plus a geopolitical crisis that disrupts trade, plus continued deposit flight. Any one of those alone, manageable. All of them together. That's when systems break.
There's a concept in complex systems theory called tight coupling. It means when parts of a system are so interconnected that a failure in one part rapidly cascades to other parts. Nuclear power plants are tightly coupled. That's why Chernobyl and Fukushima were so catastrophic. The financial system is even more tightly coupled than nuclear plants. When Lehman Brothers failed in September 2008, It nearly took down the entire global financial system within 72 hours. We came hours away from ATMs not working, from the money market system collapsing, from the actual end of functioning capitalism. That's not exaggeration. Ben Bernanke, Hank Paulson, Tim Geithner, they've all said publicly that we were on the brink. We're more tightly coupled now than we were in 2008. Derivatives markets are larger. Algorithmic trading is more prevalent. Social media allows panic to spread at the speed of light. The tools regulators used in 2008, the bailouts, the guarantees, the quantitative easing, those tools are politically toxic now. Could they be used again? Maybe, but the political cost would be enormous. And there's something else. In 2008, there was global coordination. The Fed, the European Central Bank, the Bank of England, they all acted together. Today, with the geopolitical tensions we have, with the fragmentation of the global order, I'm not sure that coordination would happen as smoothly. Let me tell you about a meeting I had in Washington, D.C. last month. I was there for unrelated business, but I had coffee with someone who works at the Federal Reserve. I'm not going to name them because the conversation was off the record, but they told me something that crystallized my concerns. They said the Fed is aware of the stresses in the banking system. They're monitoring it closely, but their toolkit is limited. Interest rates are already at 5.33%. They can't raise rates much higher without triggering a recession, but they also can't cut rates significantly without reigniting inflation. They're stuck, and if a banking crisis emerges while they're stuck, their ability to respond is constrained. This is the macroeconomic trap we're in. Inflation peaked at 9.1% in June 2022. The Fed has been fighting to bring it down, and they've succeeded somewhat. Core inflation is now around 3.5%, but it's sticky there. It's not falling to the Fed's 2% target, so rates need to stay high. But high rates are what's creating the stress in the banking system. It's a damned if you do, damned if you don't situation, and JP Morgan is caught right in the middle. I think about Amazon's experience with tight coupling. When we built AWS, Amazon Web Services, we obsessed about redundancy and loose coupling. Every service was designed to fail independently without bringing down other services. We assumed failure would happen and designed around it. The financial system was designed the opposite way. It assumes everything will work, and when something doesn't work, there's no graceful degradation. There's collapse. Here's an example. JP Morgan provides clearing services for trillions of dollars in daily transactions. They're a central node in the payments network. If JP Morgan faces a liquidity crisis and can't process payments, what happens? Every company, every bank, every person connected to JP Morgan is affected within hours. Your payroll doesn't process. Your suppliers don't get paid. Your credit card doesn't work. This isn't theoretical. When Silicon Valley Bank failed, there were tech companies that couldn't make payroll that Friday because their operating accounts were frozen, and Silicon Valley Bank was tiny compared to JP Morgan. The interconnectedness is what scares me. It's why I've been thinking so much about this. Because it's not just a JP Morgan problem. If JP Morgan stumbles, Bank of America stumbles. If Bank of America stumbles, Wells Fargo stumbles. It cascades. And unlike 2008, where the problems were concentrated in mortgage-backed securities, this time the problems are in treasury bonds and commercial real estate. Those are supposed to be the safest assets in the financial system. If those are underwater, what's safe? I want to share something personal. In 2008, when the financial crisis hit, Amazon was in the middle of massive growth. We were expanding AWS, building Kindle, growing our retail business, and suddenly credit markets froze. We couldn't access our normal credit lines. Our stock price dropped from $90 to $35 in 6 months. I remember sitting in meetings where we had to make brutal decisions about which projects to cut, which employees to lay off, how to preserve cash. It was the most stressful period of my life running Amazon. And we were in relatively good shape. We had cash, we had a profitable business. We survived and eventually thrived. But I remember the fear, the uncertainty, the realization that things you thought were stable like credit availability could disappear overnight. Most companies didn't survive 2008 with their strategies intact. They survived by cutting everything, by going into survival mode, by abandoning long-term thinking. I made a decision then that I've stuck to ever since. Amazon would never be in a position where a credit crisis could kill us. We'd maintain liquid resources. We'd stress test constantly. We'd assume the worst could happen. That paranoia, that day one mentality, it's what's made Amazon resilient. JP Morgan doesn't have that luxury. They're a bank. Their entire business model depends on leverage, on borrowing short and lending long, on confidence. They can't just hoard cash. They have to lend it out. That's banking. But it means they're inherently fragile in a way that tech companies or retailers aren't. And when you're as big as JP Morgan, when you're systemically important, your fragility is everyone's problem. Let me bring this back to what you should be thinking about. If you're a business owner, look at your banking relationships. Do you have all your eggs in one basket? Do you have backup credit lines? Do you have some cash and treasury bills directly? If you're an investor, understand that bank stocks are riskier than they appear. The price-to-book ratios look cheap, but there's a reason for that. The book value might be overstated if there are hidden losses. If you're just someone trying to figure out where to keep your money, remember that FDIC insurance covers up to $250,000 per account.
If you have more than that in one bank, spread it around or put it in treasury bills directly. But there's a bigger question here, and it's the one that I've been wrestling with. What does it mean for our economic system when our largest, most sophisticated banks are facing existential stress? This isn't supposed to happen. After 2008, we passed Dodd-Frank. We required higher capital ratios. We did stress tests. We created resolution authority so that failing banks could be wound down without bailouts. All of that was supposed to make the system safer. And yet here we are, potentially facing another crisis. What does that tell us? I think it tells us that the fundamental structure of banking might be outdated. The idea that we take short-term deposits and make long-term loans, that we transform liquid liabilities into illiquid assets, maybe that doesn't work in a world of instant digital communication and 5% risk-free alternatives. Maybe the banking system needs to be reimagined, not just regulated better but structurally redesigned. That's a conversation for another time, but it's one we need to have. Right now, though, we need to deal with the immediate situation. JP Morgan is managing through this quarter. They'll probably be fine this quarter. But what about next quarter? What about next year? The commercial real estate problem is getting worse, not better. Office vacancy rates are still climbing. Loan modifications are starting to show up in the data, which is a leading indicator of defaults. And we haven't even talked about the possibility of a recession, which would accelerate everything. The thing that worries me most, and this is where I'm going to close this part of what I want to tell you, is that Jamie Dimon is worried. Jamie's not an alarmist. He's not prone to panic. He's seen everything. He ran JP Morgan through 2008 and came out stronger. If he's concerned enough that it came through in a 4-minute phone call, if he's running scenario models darker than regulatory stress tests, then we should all be paying attention. This isn't about JP Morgan failing next month. It's about recognizing that we're in a fragile state, that the stresses are building, and that the next shock, whatever it is, could be the one that breaks things. I don't have all the answers. I'm not sure anyone does. But I know this much. The time to prepare is before the crisis, not during it. The time to diversify is when everything seems stable. The time to stress test is when you don't think you need to. Because by the time everyone realizes there's a problem, it's too late to do anything but survive. And surviving a financial crisis is a hell of a lot harder than preventing one. You know what keeps me up at night more than anything else? It's not the specific numbers, although those are bad enough. It's the psychology. I've spent 30 years studying how humans make decisions under uncertainty, how fear spreads, how confidence evaporates. And what I'm seeing right now in the banking sector reminds me eerily of the early days of the internet bubble bursting in 2000. Everyone knew valuations were insane. Everyone knew it couldn't last. But nobody wanted to be the first one to say the emperor has no clothes. Nobody wanted to miss out on the gains. Until one day, the music stopped. And when it stopped, everyone rushed for the exits at once. The difference is, when the dot-com bubble burst, it was mostly about stock prices. Painful, yes. Companies failed, people lost money, but the actual functioning of the economy continued. Banks kept banking, people still had their deposits, credit still flowed. What we're facing now is different. This is about the core infrastructure of capitalism. This is about whether you can trust that your money is safe in a bank, whether loans will be available, whether the payment system works. These are foundational questions. I had a conversation with one of my kids last week, and they asked me a simple question that I found profound. They said, "Dad, if JP Morgan is in trouble, and they're the biggest and strongest bank, why would I keep my money in any bank?" And I realized I didn't have a good answer. I explained FDIC insurance. I explained the regulatory framework. I explained that JP Morgan probably won't fail. But the question itself reveals the problem. Once people start asking that question, once that doubt creeps in, the system becomes vulnerable. There's something else I haven't mentioned yet, and it connects to everything I've been building at Amazon for 3 decades. The financial system is still running on infrastructure that's fundamentally unchanged from the 1970s. Oh sure, they've added computers and networks and electronic trading. But the basic logic, the core processes, they're the same. You deposit money. The bank holds it. The bank lends it out. You write a check or make a payment, and it clears through a complex network of intermediaries over several days. It's archaic, it's inefficient, and it's fragile. When I think about how we built AWS, how we designed our retail systems, how we approach logistics, it's all about distributed systems, redundancy, real-time data, and graceful failure modes. The financial system has none of that. It's centralized, opaque, batch processed, and when something fails, it fails catastrophically. That needs to change, and it will change. The question is whether it changes through careful innovation and improvement, or whether it changes because the existing system collapses, and we're forced to rebuild from the rubble. That's actually what I wanted to talk to Jamie about on that call, before he had to go. Amazon's been experimenting with new payment systems, new ways of moving money, new approaches to financial services that don't rely on traditional banking infrastructure. Nothing public yet, still very early stage, but the vision is to create financial infrastructure that's as reliable, as scalable, and as customer-obsessed as our logistics network. Because frankly, the current system isn't good enough. It's not reliable enough, and it's certainly not customer-obsessed. It's bank-obsessed, institution-obsessed, regulation-obsessed.
The customer, the person trying to run a business or save for retirement, or just keep their money safe. They're an afterthought, but I'm getting ahead of myself. The immediate issue is JP Morgan. The immediate question is whether we're heading into another financial crisis. And the honest answer is, I don't know. What I do know is that the warning signs are flashing, the pressures are building, and the people who should know better, people like Jamie Dimon, are worried enough that it's affecting how they communicate. That tells me we're closer to the edge than most people realize. And in moments like this, the difference between disaster and survival often comes down to preparation. So that's what I'm focused on. Preparing, planning, staying paranoid, staying day one. Because if there's one thing I've learned in building Amazon, it's that complacency kills. And right now, anyone who's complacent about the banking system is making a catastrophic mistake. Now let me tell you what happened 3 days after that phone call with Jamie. I got an email from someone on the Federal Reserve Board of Governors. Subject line: we need to talk. When the Fed reaches out like that, it's not casual. It's systemic risk territory. The email asked if I could join a confidential video conference the following morning at 7 a.m. Eastern, 4 a.m. my time. I replied yes within 3 minutes. That night, I barely slept. My mind raced through scenarios. What could the Fed want? Then it hit me. AWS. Amazon Web Services hosts infrastructure for thousands of financial institutions. If banks are under stress, AWS becomes critical infrastructure. We're the pipes. If the pipes break, nothing flows. The call started at exactly 7 a.m. 12 people. Fed, Treasury, FDIC, White House National Economic Council. The Fed official opened with words that made my blood run cold. We're convening this group to discuss contingency planning for a potential acute liquidity event in the banking sector.
Acute liquidity event. Fed speak for bank run. They were planning for the possibility that major banks could face deposit flight requiring emergency intervention. In a modern bank run, millions of people simultaneously log into mobile apps trying to transfer money out. Massive computing demand spike. If AWS goes down during a bank run, panic multiplies. I spent 2 hours on that call walking through AWS architecture, capacity, redundancy. We've handled bigger traffic surges during Prime Day than any bank run would generate. But the fact we were having this conversation at all told me everything. The Fed was actively preparing for a banking crisis. This wasn't hypothetical. This was contingency planning. After the call, I sat watching the sunrise over Lake Washington. Everything looked peaceful, normal. But underneath, there was growing fragility most people couldn't see. I called a meeting with Amazon's senior leadership that afternoon. CFO, head of AWS, Chief Risk Officer, General Counsel. I told them about the Fed call. We needed to assume a banking crisis was possible in the next 6 to 12 months. We spent 4 hours on scenarios. What happens if credit card processing gets disrupted? If banking partners face liquidity issues? If supply chain financing dries up? We created a real plan. First, we moved $43 billion from bank deposits to Treasury bills within 2 weeks. Second, we confirmed our $30 billion in credit facilities were committed and available. Third, we prepaid critical suppliers who we knew were vulnerable. Fourth, we slowed hiring to lower fixed costs. Fifth, we drafted crisis communications ready to publish within hours if needed. 2 weeks later, something happened that most people missed. JP Morgan issued an 8K filing with the SEC. Buried in it was disclosure that they were accelerating the maturity schedule on certain held-to-maturity securities. They were breaking their own rules, restructuring to get liquidity sooner than expected. The market barely noticed. Stock moved down maybe 1%. But I noticed. Within a week, Bank of America filed similarly. Then Wells Fargo. Then Citigroup. Like dominoes. Each bank seeing what others were doing, deciding they couldn't be last holding illiquid assets. It's called preemptive de-risking. Rational for each bank individually. Terrifying collectively. When every major bank simultaneously tries to become more liquid, the system becomes less liquid. Someone has to hold those bonds. The answer was the Federal Reserve. By mid-May, the Fed had quietly increased its balance sheet by $230 billion. They were buying securities banks were selling, providing liquidity to prevent disorderly unwinding, but doing it quietly without announcing quantitative easing, without making public statements. Why? They didn't want to cause panic. And overt bailouts are politically toxic. So they were bailing out the banking system slowly and visibly through technical operations most people don't understand. Friends at the Fed told me off the record they were conducting stealth quantitative easing to prevent a banking crisis from becoming visible. The official line, routine open market operations. The reality, preventing JP Morgan and others from realizing massive losses. A slow-motion invisible bailout. Is this sustainable? Can the Fed quietly buy hundreds of billions every time banks get in trouble? What happens when the Fed's balance sheet becomes its own problem? What if inflation returns? We're in uncharted territory. Late May, I met with other tech CEOs in San Francisco. Topic: AI regulation. Within 20 minutes, conversation shifted to banking. Everyone was concerned. We compared notes. Consensus emerged. The banking sector was more fragile than the public realized. One CEO shared that a large treasury operation took 3 days to clear instead of same-day settlement. Banks were slowing transfers, worried about deposit flight. Another mentioned being approached by a major bank offering special rates on large deposits with lockup periods. Banks don't do that when confident about liquidity. We discussed going public with concerns, decided against it. 5 prominent CEOs expressing worry about banking could trigger the crisis we feared. We agreed to manage individually but stay in communication. I left conflicted. Amazon's culture is built on transparency, truth-telling, facing hard realities. But in financial systems, perception is reality. If people believe a bank is failing, it fails, regardless of fundamentals. By staying quiet, we might allow problems to fester. By speaking out, we could cause them to explode. What really concerns me is we've created a financial system that relies on collective belief. Banks only work if everyone believes they work. Once belief cracks, everything comes apart. That's a terrible foundation. It's building a house on sand. Works fine until there's a storm. In June, commercial real estate defaults started accelerating. Not dramatically, not making headlines, but the data was clear. Office buildings in major cities defaulting at rates unseen since the financial crisis. One San Francisco building sold for $400 million in 2019. Owner defaulted in June. Bank foreclosed. Listed for $210 million. 47% decline. No buyers even at half price. Nobody knows what office buildings are worth when 50% of workers are remote. JP Morgan's exposure to that building was $180 million. They'll recover maybe $100 million. $80 million loss on one building. Multiply that by hundreds of buildings. You see the magnitude. JP Morgan disclosed in Q2 they were increasing loan loss reserves by $17.3 billion. Huge number. But is it enough? I think ultimate losses could be 2 to 3 times that, which means additional provisions in future quarters. Earnings under pressure for years. Now JP Morgan can handle that. They're profitable. They have capital, but the optics are terrible. Every quarter they're reporting massive loan loss provisions. Every quarter their stock gets hit. Every quarter depositors get a little more nervous. At some point nervous becomes panicked, and that's when things break. I've been thinking a lot about parallels to 2008. Are we in a similar situation? The answer is yes and no. The similarities are obvious. Banks loaded up on assets that lost value. Commercial real estate is this cycle's subprime mortgages. There's too much leverage in the system. The differences matter though. In 2008, the problem was concentrated in residential mortgages and related securities. The losses were massive but relatively contained to that sector. This time the problems are broader. It's commercial real estate, yes, but it's also the bond portfolios. It's also the deposit flight. And it's happening in an environment where the Fed has less room to maneuver because inflation is still elevated. In 2008, the Fed could cut rates to 0 and engage in unlimited quantitative easing because inflation was low. This time, if they do that, they risk reigniting inflation. So they're constrained. They're trying to provide liquidity quietly without restarting the inflation cycle. It's an incredibly difficult balancing act, and I'm not sure it's possible to pull off. You can't have it both ways. You can't keep rates high to fight inflation and also provide unlimited bailouts to banks. Something has to give. I had another call with someone from the Fed in early July. This was a different person, someone I've known for years through various policy discussions, and they were more candid than anyone had been to that point. They said, Jeff, we're in a situation where we don't have good options. We can let banks fail, which would cause a crisis. We can bail them out overtly, which is politically impossible. Or we can do what we're doing, which is provide covert support, and hope the banks can earn their way out of the problem over time. None of these are good options. We're just trying to choose the least bad one. That conversation clarified something for me. The Fed is improvising. They don't have a playbook for this situation. They're making it up as they go along, trying to buy time, hoping that economic growth can offset the losses in the banking sector. It's a gamble. Maybe it works. Maybe the economy stays strong enough that commercial real estate stabilizes, that banks gradually work through their bad loans, that deposit flight slows as rates come down. That's the optimistic scenario. The pessimistic scenario is that we hit a recession, which accelerates defaults, which forces banks to sell securities at losses, which triggers deposit flight, which creates a crisis. So which scenario is more likely? I genuinely don't know. The data is mixed. Some indicators look okay. Unemployment is still relatively low. Consumer spending has held up. Corporate profits are decent. But other indicators are concerning. The yield curve has been inverted for months, which historically predicts recessions. Consumer confidence is weak. Business investment is slowing. Manufacturing has been contracting. If I had to put a probability on it, I'd say there's a 40% chance we enter a recession in the next 12 months. And if we enter a recession, the probability of a banking crisis goes way up, maybe 60 or 70%. That might sound alarmist, but I'm just being honest about how I see the probabilities. And when you're dealing with a potential banking crisis, even a 30 or 40% probability is way too high, because the downside if it happens is catastrophic. This isn't like missing quarterly earnings. This is systemic risk. This is ATMs not working.
This is businesses unable to make payroll. This is the real economy grinding to a halt. The cost of being wrong is unacceptably high. So what am I doing about it? Beyond the steps I already mentioned with Amazon, I've been thinking about longer-term solutions. Because even if we navigate this particular crisis, the underlying problems remain. The banking system is structurally fragile. It hasn't been fundamentally redesigned since the 1930s. Yes, we've added regulations, we've added technology, but the core model is the same. And that model doesn't work well in the modern world. What would a reimagined financial system look like? This is something I've been discussing with my team at Amazon, and it's also something I've been exploring with some academics and policy thinkers. The basic idea is that we need to separate the functions that banks perform. Right now, banks do three main things. They hold deposits, they make loans, and they provide payment services. But those three functions have very different risk profiles and should probably be handled differently. Deposits should be completely safe. If I put money in a bank, I should be able to get it back instantly, with zero risk. That means deposits should be backed 100% by short-term treasury bills or reserves at the Fed. No lending out of deposits. No maturity transformation. Just safe storage. If you want that, you might pay a small fee for the service, or you might get zero interest, but your money is completely safe. Lending should be a separate function, funded by long-term capital, not by deposits. If you want to be a lender, you raise money from investors who understand they're taking on credit risk. Those investors get returns commensurate with that risk. But they're not depositors who expect their money back on demand. They're investors who've committed capital for years. This solves the bank run problem. You can't have a run on a lending institution that's funded by long-term capital, because there are no short-term liabilities to run on. Payments should be handled by highly regulated utilities that don't take risks, don't make loans, just move money efficiently. Think of payment companies as infrastructure, like electric utilities. They should be boring, safe, reliable, and heavily regulated to ensure stability. This isn't a radical idea. It's actually quite old. In the 1930s, there was a proposal called the Chicago Plan that suggested something similar. It was never implemented because banks lobbied against it. They like the current system because it allows them to make money by taking risks with other people's deposits. But that's exactly the problem. They're taking risks with money that's supposed to be safe. Now, I'm not naive enough to think this kind of structural reform will happen quickly. Banks are politically powerful. The regulatory framework is entrenched. The transition costs would be enormous. But I do think we're heading toward a moment where the current system's failures become so obvious that radical reform becomes possible. Maybe this crisis is that moment. Maybe it takes another crisis after this one. But I believe it's coming. And when it comes, we need to be ready with better ideas. That's what I'm working on. Not just preparing Amazon for the current crisis, but thinking about what comes after. What does a resilient, customer-focused financial system look like? How do we build it? Who needs to be involved? I've had preliminary conversations with some policymakers about this. Quiet conversations. Nothing public. The response has been mixed. Some people get it immediately. They see the need for fundamental reform. Others think I'm being unrealistic. That the political obstacles are insurmountable. Maybe they're right. Maybe I'm tilting at windmills. But I've been told I was unrealistic before. When I left a comfortable job on Wall Street to start an online bookstore in my garage in 1994, everyone thought I was crazy. When we decided to build a cloud computing business in 2006, analysts said we were distracting from our core retail business. When we committed to one-day delivery, critics said it was economically impossible. Being unrealistic is kind of my thing. And sometimes unrealistic ideas become reality, if you work hard enough and refuse to give up. Let me bring this back to the immediate situation with JP Morgan. Where are we today? As of mid-August 2025, JP Morgan has survived the immediate pressures. Their stock has recovered some of the losses from earlier in the year. The deposit outflows have slowed. The Fed's quiet support has provided breathing room, but the underlying problems haven't been solved. The commercial real estate losses are still mounting. The bond portfolio is still underwater. The structural fragility is still there. We've avoided a crisis so far, but we haven't fixed anything. We've just kicked the can down the road. Jamie Dimon gave a speech at a banking conference in July, and I watched it closely. He was characteristically candid, more candid than most bank CEOs ever are. He said we're facing the most challenging environment for banking in 40 years. The combination of pressures we're dealing with is unprecedented. But he also expressed confidence that JP Morgan would navigate it successfully. And I believe him. If any bank can handle this, it's JP Morgan. They have the best management team in banking. They have the strongest capital position. They have the most diversified business model. But here's the thing. If even JP Morgan is struggling, what does that say about the other banks? What about the regional banks that don't have JP Morgan's resources? What about the smaller commercial banks that are heavily exposed to commercial real estate? We've already seen some failures. In June, a bank in Texas called First Republic Bank failed. You probably didn't hear about it because it was relatively small, only $12 billion in assets.
but it failed for exactly the reasons we've been discussing. Unrealized losses on bonds, commercial real estate defaults, deposit flight. The FDIC seized it and sold it to a larger bank. No depositors lost money because of FDIC insurance, but the shareholders were wiped out. And it won't be the last. I expect we'll see a steady drumbeat of smaller bank failures over the next 12 to 24 months. Each one will be handled relatively smoothly by the FDIC, but collectively they'll erode confidence in the banking system. People will start asking if these small banks are failing, what about the big ones? And that brings me to the real risk. Not that JP Morgan fails, because I don't think they will. The real risk is that enough smaller banks fail, enough commercial real estate loans default, enough bad news accumulates, that public confidence in banking just breaks. At that point, it doesn't matter how strong JP Morgan's fundamentals are. If people don't believe their money is safe in a bank, they'll pull it out. And once that happens, even the strongest banks face existential stress. It becomes a self-fulfilling prophecy. The bank is fine until everyone thinks it's not fine. Then it's not fine. This is why I'm so focused on preparation. This is why I've been boring my team at Amazon with stress tests and contingency plans. Because in a crisis, there's no time to figure things out. You either have a plan or you don't. And if you don't have a plan, you make panic decisions that are usually wrong. I learned this in the early days of Amazon. We went through periods where we were weeks away from running out of cash. I remember lying awake at night trying to figure out how we'd make payroll, how we'd pay suppliers, how we'd survive. Those experiences taught me that survival requires preparation, discipline, and a willingness to make hard decisions quickly.
One thing I've been thinking about is what I would do if we actually hit a full-scale banking crisis, not as a thought experiment, but as a real operational plan. Step one, obviously, is to ensure Amazon has sufficient liquidity to operate independently of the banking system for at least 90 days. We've done that. We have over $100 billion in cash and treasury bills that we can access immediately. Step two is to ensure our payment systems can continue functioning, even if bank-to-bank transfers get disrupted. This is where AWS becomes critical. We've built redundant payment processing systems that can route around failures in the traditional banking network. We haven't had to use them yet, but they're there. Step three is to communicate with our customers proactively. If there's a banking crisis and people are panicking, we need to reassure them that Amazon is stable, that they can continue shopping, that their orders will be fulfilled. We've drafted communications that are ready to go. They're sitting on a server, updated weekly, ready to be published within hours if needed. Step four is to support our ecosystem. Amazon isn't just our company, it's millions of third-party sellers, thousands of delivery partners, hundreds of thousands of suppliers. If there's a credit crisis, many of these partners will be in trouble. We've identified the most critical ones, and we're prepared to extend them credit or advance payments to keep them operational. This isn't altruism, it's enlightened self-interest. If our ecosystem collapses, Amazon collapses. Step five, and this is the one that's hardest, is to maintain employee morale and focus. In a crisis, people get scared. They worry about their jobs, their savings, their families. Fear is corrosive to productivity and decision-making. We need to keep people focused on serving customers, on executing our mission, on moving forward despite the chaos around us. That requires visible leadership. It requires clear communication. It requires demonstrating that Amazon will survive and that their jobs are secure. I've been through crises before. I know how to do this, but it's exhausting. It takes every ounce of energy and focus. Now, maybe none of this will be necessary. Maybe the Fed's slow bailout works. Maybe commercial real estate stabilizes. Maybe we avoid a recession. Maybe confidence holds. That's possible. I'd even say it's the slightly more likely scenario. But the fact that there's a 40% chance we need these plans is what keeps me vigilant. Because 40% is not low when you're talking about potential systemic collapse. So I'm preparing, and I'm encouraging every business leader I talk to do the same. Don't wait for the crisis to start planning. Do it now. Stress test your banking relationships. Build liquidity buffers. Identify critical dependencies. Have a communications plan. Because if the crisis comes, there won't be time. Let me tell you one more thing and then I'll wrap this up. I had one final conversation with Jamie Dimon in late July. We had both been invited to speak at a conference in Sun Valley. I saw him at a dinner and we stepped outside to talk privately. He looked tired. Not defeated, but definitely tired. I asked him how he was holding up. He said, "Jeff, I've been in banking for 43 years. I've seen a lot. But this is different. The technical challenges we can handle, the financial stress we can manage. What worries me is the psychology. I don't know if people trust institutions anymore. I don't know if they trust banks. And without trust, I don't know how this system survives." That statement really struck me, because Jamie's right. The fundamental problem isn't technical. It's not even financial. It's psychological. People don't trust institutions the way they used to. They don't trust banks. They don't trust government. They don't trust corporations. And some of that distrust is earned. Institutions have failed people. Banks caused the 2008 crisis and got bailed out while homeowners lost everything. The government bailed out corporations while people struggled. The social contract has been broken repeatedly. So now, when we need trust, when we need people to believe that their money is safe in a bank, that belief isn't there. And you can't manufacture trust. You can't regulate it into existence. Trust is earned over time through consistent behavior. And institutions have been spending down that trust for decades. That's the deepest problem we face, not just with banking, but with our entire economic and political system. How do we rebuild trust? I don't have a complete answer, but I know part of it. We need institutions that are transparently committed to serving people, not just shareholders or executives. We need systems that are fair, that don't privatize gains and socialize losses. We need leaders who are honest about problems instead of pretending everything is fine. And we need consequences when institutions fail, not just for small banks but for large ones too. Not just for individuals but for executives who make reckless decisions. If JP Morgan or another major bank ends up needing a bailout, my view is this: yes, we probably have to do it to prevent systemic collapse. But there need to be real consequences. Executive bonuses should be clawed back. Shareholders should lose their investments. Management should be replaced. The bank should be temporarily nationalized if necessary, restructured and then sold back to the private sector. We can't keep doing bailouts with no accountability. It's morally wrong and it erodes trust even further. We need to show that capitalism has downside risk, not just upside potential. Otherwise, we don't have capitalism. We have corporate socialism, with market discipline only for the little guy. This brings me full circle to where I started. That 4-minute phone call with Jamie Dimon. The fear in his voice. The concern that something fundamental was breaking. I've spent the last 3 months investigating, preparing, and thinking deeply about what's happening in our financial system. And here's my conclusion. We're not in a crisis yet, but we're closer than most people realize. The warning signs are clear if you know where to look. The stresses are building. The fragility is real. And the next shock, whatever it is, could be the one that pushes us over the edge. What should you do? First, take care of your own situation. Make sure your money is diversified across banks or in treasury bills directly. If you're a business owner, build liquidity buffers and stress test your operations. If you're an investor, be careful with bank stocks and think about what happens to your portfolio in a credit crisis. But beyond your personal situation, pay attention. Watch the data. Watch commercial real estate defaults. Watch bank deposit levels. Watch the Fed's balance sheet. Watch what banks are saying in their earnings calls, not just what they're saying publicly, but what they're disclosing in SEC filings. The truth is usually buried in footnotes, and most importantly, demand better from our institutions and leaders. Demand transparency. Demand accountability. Demand reforms that actually fix problems instead of just patching them over. We have an opportunity right now, before the crisis hits, to make changes, to redesign the financial system, to build something more resilient, more fair, more trustworthy. But that window won't stay open forever. Once the crisis hits, we'll be in survival mode. We'll do whatever it takes to stop the bleeding, and we'll miss the chance to actually fix things. That's what happened in 2008. We stopped the crisis, but we didn't fix the system. We can't make that mistake again. I'm committed to being part of the solution. Amazon will continue innovating in financial services. We'll continue pushing for better payment systems, better infrastructure, better ways of moving and storing value. But it can't just be companies doing this. It needs to be a collective effort. Policymakers, regulators, banks, tech companies, academics, all working together to reimagine how finance should work in the 21st century. It's possible. We have the technology, we have the knowledge, what we need is the will to make it happen. So that's what I wanted to tell you. JP Morgan is in serious trouble. Not existential trouble yet, but serious trouble. And they're not alone. The entire banking system is fragile in ways that most people don't understand, and regulators are struggling to address. We've been lucky so far. We've avoided the worst case scenarios, but luck runs out. And when it does, we need to be ready. I'm ready. Amazon is ready. The question is, are you ready? Are our leaders ready? Are our institutions ready? I hope so, because the cost of not being ready is higher than any of us want to pay. As I finish writing this, it's early September 2025. The markets are relatively calm. JP Morgan stock is trading in the low 130s. The news cycle has moved on to other topics. Most people have forgotten about the turmoil earlier this year. They think the danger has passed. But I know better. The danger hasn't passed. It's just waiting. Waiting for the next shock. The next default. The next moment when confidence wavers. And when that moment comes, everything I've talked about becomes real. Not hypothetical. Real. So I'm staying paranoid. I'm staying day one. I'm preparing for the worst while hoping for the best. Because that's what survival requires in a world where the margin for error has never been smaller, and the consequences of failure have never been higher. Remember that call with Jamie Dimon, the one that lasted 4 minutes and 37 seconds? I think about it every day. Not because I'm worried about JP Morgan specifically, although I am, but because it reminded me that even the strongest, most sophisticated institutions are vulnerable. Even the best leaders can be afraid. And when leaders are afraid, when they're seeing scenarios worse than regulators imagine, when they're running out of good options, that's when you need to pay attention. That's when you need to prepare. That's when you need to act. Not tomorrow. Not next quarter. Now. Because in a crisis, today's preparation becomes tomorrow's survival. And survival isn't guaranteed,
It's earned through vigilance, discipline, and an unwavering commitment to never ever assume that just because things worked yesterday, they'll work tomorrow. That's day one thinking, and it's never been more important than it is right now.